Folks, as you heard in the daily financial news, January 15th, CPI core came in slightly better than expected. The 10-year note rate started crashing, at one point being down 16 basis points. We talked about mortgage rates going down, maybe, just maybe, sub 7%. Folks, is this the start of a new trend? If you like it, lock it. Has it gone out the window? You should just surf the trend. We've also heard that refis are up 40+% in demand. Purchases are up 26%. Is the world going crazy? What the heck is going on? Let's talk to Matt, the mortgage guy, and really see what's going on the ground. Matt, what say you?
Right. Yeah. Before we get into mortgage rates, I think that's funny, talking about, refinance demand up and purchase demand up, which we know all that data, like that data was already written before any of this change happened. So you can't correlate the two, like, oh, inflation's down, rates are down, applications are up. But what I will tell you is before today's inflation number, I would have guessed mortgage applications up because I wasn't the only one that saw like, holy moly, like a lot of referrals coming in. A lot of people, are interested in getting out there and buying. And I had a conversation with one of my investor clients yesterday, trying to figure out buyer sentiment. What is it? Are they finally just giving in and saying like, I'm going to find a deal at this rate. I'm not going to wait for better market conditions or lower rates or whatever, the excuse was for people waiting. But yeah, it seemed like there was a little bit of a spur of demand for whatever reason. But let's talk about something that you and I agree on, and we'll try to talk some sense into people listening, because I've done it before and it doesn't always seem to work. Rates
human psychology is a tough thing to beat.
Right. And rates, when they're trending up, people are disheartened for whatever reason, even though the best investors never look at rate. That was another good conversation I had yesterday. The investor was like, I didn't even look at the DSCR stuff when I bought those 5 houses in Tennessee. And boy, I'm glad I didn't care about rate because the rates were in the 8s, but I've got 5 great investment properties. But last Friday was a bad day for mortgage rates. And, if you look at like Mortgage News Daily or something, and you look at the 30-year average for somebody with a great scenario, that might've gone from 7 1/8 to 7 1/4, 713 to 726, whatever you want to call it. We're back to Thursday's rates at last I checked, right? We got, some downward pressure on rates because of this inflation number. And so from that 726 back to 7.13, back, 7 1/4 to 7 1/8. So we got that 1/8 back. Here's the problem, and here's where people need to listen up. There's no evidence and there's no signs pointing to we're going to continue to see mortgage rates trend down. So, somebody who's got a lot of mortgage knowledge was talking about we're still locking on something that's closing the next 15 days, still locking on something closing the next 30, still locking on something that's 45 days plus. And the reason being, like, you put your head in the shark's mouth because you didn't know what inflation number was going to do today, and the shark didn't bite you. Rates went down. That doesn't mean you put your head back in his mouth, right? Yeah. Like if you get a contract today,
a great
or tomorrow,
analogy.
Yeah. You still lock it, and so
let's talk about human psychology, because again, as somebody who's studied the consumer for 30 years, it is laughable how predictable the masses are, right? You individually, not really predictable. But when I look at the collection of everyone, they're predictable. And this is generally what happens. And maybe if you recognize it, you could see it coming. So when rates are ticking higher, generally speaking, it is very easy to share that data and get somebody to say, if I like it, lock it, right? You're only doing great deals. It cash flows day one. You know the drill. But as soon as we have a good day, even if it's only one, great day, like today, I think will go down as a great day. Your shark analogy is awesome. Most consumers, like a high percentage of it, see the great day and assume tomorrow will be a great day. Now, again, you might be right. And I'll admit something right here, right now. You tell me that CPI headline comes in at 2.9, like it did. You tell me that inflation goes from 2.4 to 2.6 to 2.7 to 2.9, like it did. I'm not going to guess rates go down 16 basis points. That would not have been my guess. I would have lost money. So again, I have no idea what will come tomorrow, but I can tell you there are a lot of consumers that have looked at today's great day. The shark didn't bite them, and they are naturally going to put their head back in the mouth and go, let's go 2 for 2, baby. Bet on black. Bet on black.
Yeah, we went from here to here. So tomorrow we might go to here. The day after we might go to here. What people need to hear is that, rate sheets are better today, January 15th, 2025, than they were yesterday, right? A little relief rally because, inflation didn't even come in that much better. It just didn't come in worse. It kind of met expectations.
It still went up. CPI headline.
Right.
CPI core did.
And
go
so,
down.
markets were afraid that we're going to see increased inflation, and we didn't. And so they're improving on that news, but it's not a trend for lower rates. There's still, nobody's changed their view on 2025 rate cuts, right? So like none of that stuff has changed. This was just one report, deep breath. Okay. It didn't hurt us. So, we get a little bit of improvement, but yeah, it's not a sign of the future. There's other times where you maybe looked at data and you're like, okay, this could be the start of a rally. In today's case, it's really not. And so take those gains, because what happens. Yeah. Just real quick, Mike, like from somebody who watches rates daily, no matter which way it goes, there's always a reaction and then a little bit of retracement, good or bad. So on rate sheets, if it was 50 or 60 basis points, which translated to an eighth in rate, we might give back 15, 20, 25 basis points of that betterment. Just like when things get worse, we kind of, get a little bit better after the big initial reaction. And so today more than ever, if you like it, lock it, because you got this big improvement, take it.
Yeah. It's interesting, right? As somebody who studies the consumer and the economy, I'm not sure if anybody with a sound mind can look at the next 30 days and not see uncertainty, right? I don't care if you're red, blue, liberal, conservative, whatever. The next 30 days are full of uncertainty. And one might argue chaos. History says that the bond market, doesn't like that. Now, who knows what happens at the end of these 30 days? For all I know, we could have a brand new Fed chair. Not something I'm calling for, but you never know, right? And, rates could be way down. Could be. I'm not saying will. I'm just sitting here saying I don't know what's coming. But rates could also be meaningfully higher. I think the next 30 days are perhaps going to be some of the most chaotic times. Lots of cross currents, a lot of splashy headlines, a lot of fear, a lot of this, that, and the other. And generally speaking, money, debt, bonds don't like that.
Yep.
And buckle up.
Yep. No, exactly. It's volatility is something that mortgage bonds definitely don't like, and quite honestly, volatility in the future, it feels a lot more risk to the upside as far as rates getting higher than it is to the downside. Like there's no part of me that's like, we could be really volatile and we could see rates go down by 0.5% in the next 30 to 45 days. That seems way less likely, almost impossible, versus like, what? Like with some volatility, rates could go from 7.25 to 7.75. Like that to me is probably 10x more probable than them going the other way.
Yeah, well, let me ask you this: what do you think the chances are we see a 6 handle? Which again, we're probably within 10 basis points of that. What do you think the chances are we see a 6.99 or better by the end of February? 0 to 100.
0 to 100, 100 being like absolutely certain.
Yes.
I would say somewhere in the 70s. Let's call it 70.
So I just want to be clear. You're saying there's a 70% chance that the Mortgage Business Daily, which I think puts out the daily numbers, will print a average rate of 6.99. And I think yesterday was 7.25, if I'm not mistaken.
Yeah, and then today it's like 713. So we're halfway home. That other eighth, like I said, it's not guaranteed. And to be honest,
It's funny that you say 70%, because for all of this conversation, we're saying if you like it, lock it. But you're saying there's a 7 in 10 chance that rates print, at least for a day, a 6.99.
Well, I wear rose-colored glasses, Mike.
Yeah.
You know that.
Yes,
You know
I'm
that
aware. I'm aware. Probably multiple of them.
Very, very rosy. I just 70.
I'll take the other side. I think it's less than 20. And again, I agree with you. We're halfway there. One day of volatility, cut it in half. So I am probably on the wrong side of this, but again, I think the next 30 days, the risk is to the upside. And I'm going to call it less than 1 in 4.
Yeah, I mean, I might have painted it a little bit rosy, and to be honest, I think that like if we even said like the next third from now to mid-February,
yeah,
that number is a lot lower.
That's exactly what. Did you not understand the question? In the next 30 days.
Oh, I thought you said the end of February. I thought you.
I might have. So maybe it was my bad. So 30 days, middle of February.
And so with these rose-colored glasses, I start to see things, right? I start to see like, well, there's going to be a January inflation print that we get in February, so maybe that has that gets us there. Because I was going to say, like, if you chunked it in 15, 30, and 45 days, it's probably like, a 15 to 20 for me in the next 15 days. Okay. And then a 35 to 40 over the next 30 days.
Okay. I see.
And then, by the end of February, I'm giving it, the likelihood, but it depends on things. Like you said, there's got to be, more tailwinds than headwinds the first 30 days of the new administration. There's got to be, an inflation print that comes, that is,
better than expected.
And so, there's a lot. But I just can't help myself, Mike. I
know you're team buyer and buyers want lower rates, but I am curious about this 44% uptick in refis. I think it was 26 or 27% uptick in purchases. And you're absolutely right. That data print was for last week, pre-goodness. I am curious, even since this morning, has your phone been ringing more this morning, even though the news is 8 hours old?
Over the last 7 days, I would call it, like this last weekend was a more active weekend than I thought. I think that, generally speaking, new year, new me, going to buy a house, people make that decision. I don't think that they necessarily moved on that decision for the first 10 days of the year. And it felt like everybody did this weekend, because I remember, talking to colleagues. I got 5 new applications. I got 2 into contract, and, people had started to make moves. But what really baffles my mind, to be honest, is the refinance number. Like, who are those people?
That's a great question, because again, I think when you really when you and I say refi, maybe the customer or the people watching this think refi, they're just naturally thinking owner-occ refi, right? Either rate and term or cash out refi. But if you step back and look at the bigger mortgage picture, we have a lot of investors coming off hard money loans because they couldn't sell their flip, right? I don't know if you guys know this, but typically flippers will get hard money loans, 6-month clock, 12% interest, and maybe they couldn't sell. So they got to get out of that debt. That will count as a refi. Right. Maybe there's some people in bad DSCR loans and they want to go back and go conventional because they're going to keep it versus sell it. That's a refi. What is probably most interesting to me, and I don't have this data, you may have it or have access to it, is how many conventional loans, owner-occ, are being refied. That would be interesting. And then most importantly, how many conventional loans are rate and term versus cash out? Because my fear is we have these body shops, call centers, singing songs to people, and they're doing bad cash out refis. I mean, financially, bad refis. It's just, I don't know with that with any certainty. It's just this nagging thing on my shoulder saying, oh, consumers being hurt again.
Well, I know it has to be true, right? Because I know enough, and I guess depending on who you're quote unquote targeting as a business or who you're having these conversations with, it might change a little bit. But when I look at a company as big as UWM and they're like, listen, 38% of our business is refinance. I'm thinking to myself, like, sure, there's some credit card debt. Sure, there's some people that got into an 8.25 and it makes sense to rate in term refi. But, just looking at the whole gamut, like it makes sense for so few people of the conversations that I'm having that I can't imagine that it's so much different for other, mortgage brokers or operators in this market because, real estate continues to appreciate. And so I know, from talking to investors too, like they're trying to pull and redeploy capital. So sometimes that will make sense. But I know it. And I hope that the One Rental at a Time community and people watching this are smarter than that. But, I got something yesterday, Mike, and, this is nothing new to me. Past client of mine, it's got their name and it says regarding your mortgage with U Mortgage LLC. It's not from us, but they try to make it look like that by saying regarding your mortgage with these people. And they give this person an interest rate that cost a ton of money as a headline and as a grab. And then they show them the payment, which of course doesn't include tax and insurance. So you get your payment, you set it up with tax and insurance, you're paying $4,400 a month. And then an advertisement comes that says, listen, we'll get you 5.25. You're only going to be paying $3,083 a month. They're not telling you that it costs $22,000 for that rate. They're not telling you that, the $1,100 in mortgage insurance, property taxes, and homeowners insurance, like, that $1,100 that you're going to pay as well that goes in your payment, we won't mention that. And so the unfortunate truth is, like, some people, that's enough to grab them. And once they're grabbed by someone who's able to do enough, financial gymnastics and say, yeah, you're only saving $170 a month and we're baking $32,000 into this loan, but $170 a month, what could you do with that? Could your kids do the dance classes that they've been wanting to do for the last 2 years or whatever the heck they're telling people? People are falling for it, unfortunately.
That's been my fear. Again, when I saw these numbers explode, sure, there are some people that make sense for, but I mean, just mathematically in history, it's got to be low double digits, 20% maybe, where it's like, yeah, you know what, you really should, right? You got an 8.25, or the other thing is we got to remember some people out there have low balances, right? You owe $100,000, but you've got $50,000 in credit card debt. Well, you know what? That might make sense, right? If you do the math.
Yeah.
But it's not most people for sure.
It's definitely not most people. And the more I think about it, a lot of people, today's rate, we talked about it being 7 1/8. Somebody, through seller credit or through their own funds or whatever, if they get into contract, they might look at the rate sheet and go, you know what, 6.75 is only a 0.5 point or 3/4 point. Like, let's lock that in. I don't know when rates are going down. So just because rates were X when they bought doesn't mean that's the rate that they ended up going with.
Yep.
They did temporary buy downs. They did permanent buy downs. They got seller credit. And so honestly, Mike, I'm like, where does this refinance come from? The only thing we can do from our seats, and then hopefully the listeners receive it, is like, make sure you're working with somebody you like and trust. Make sure they can explain to you why the refinance makes sense, and they can, go line by line. And this is what the title fees cost. These are the lender fees. You're going to, bake an extra $4,400 into this loan, but you're saving $300 per month. So that's going to, break even in about 15 months. And that's what it is. If they're not explaining it to you, there's probably a reason why, because most people will just see new rate, new payment, saves me. Where do I sign?
Folks, at the end of the day, work with someone you respect. If you're getting a quote or the hard sell, I say go to greatmortgagebroker.com. You want to get started, go to greatmortgagebroker.com. Matt, where should they go?
Greatmortgagebroker.com. We're in 48 states and we're happy to help.
There you go. Thank you, buddy.